Stop watching the price. Right now, the entire Bitcoin network only creates about 450 new coins per day. But institutional funds can absorb thousands of coins in a single trading session. That mismatch is the signal we showed in the last video. And it means the Bitcoin supply crisis has already begun. So what does this mean for your Bitcoin position? It means the rules of competition have changed. You are no longer competing against miners for new coins. You are now competing directly against the largest financial institutions in the world for the existing coins. And as we will demonstrate, their strategy is not to sell. The market you see is driven by two opposing forces. On one side, you have the noise. This is the world of daily traders, panicked sellers, and automated algorithms that create volatility. This is the chaos the headlines follow. It is designed to distract you. But on the other side, a deep structural change is happening beneath the surface. The world's most strategic capital is using this noise as cover. They are quietly accumulating, and this accumulation is permanently changing who owns Bitcoin. And the strange part is that most of this buying is happening quietly. This brings us to the core mechanism, the financial black hole. While one market is made of traders splashing around, creating waves of price swings, a second, more powerful market has opened up. This market is dominated by spot Bitcoin ETFs and the corporate treasuries of public companies. And here is the critical distinction. These entities do not buy Bitcoin to sell it next week. They operate on decade-long time horizons. They buy Bitcoin to hold indefinitely, either on behalf of their clients or as a primary reserve asset on their balance sheet. Every coin they purchase is removed from the tradable market and locked into deep, institutional-grade cold storage. Think of it like this. Firms like BlackRock and Fidelity have connected giant industrial pipelines to the finite lake of available Bitcoin. While day traders create ripples on the surface, these pipelines are methodically draining the lake, day after day, into private reservoirs. And from these reservoirs, that Bitcoin may never return to the open market. Everyone is watching the waves, but they are missing the fact that the underlying water level is dropping. This is the quiet crisis. After the halving event in April 2024, the creation of new Bitcoin was permanently cut. The network now produces only around 450 new coins per day. That number is the entire new global supply for every single buyer on the planet. For Wall Street's largest asset managers, for the corporate treasuries of public companies, for nation states, and for every retail investor combined, the system only provides 450 new coins each day. This microscopic new supply is now colliding with three massive converging forces. But here's the uncomfortable question most investors are avoiding. If the system only creates 450 new Bitcoin per day, and institutions alone can absorb that supply, then where exactly are the next buyers supposed to find coins? First, institutional demand. The launch of spot Bitcoin ETFs has created a permanent and structural source of buying that did not exist in any previous cycle. This isn't speculative hot money. This is strategic, long-term allocation from the largest pools of capital in the world. This is demand that is automated and relentless. Second, holder behavior. The amount of Bitcoin held on exchanges is near a 5-year low. Coins are being withdrawn from exchanges and moved into private wallets at a historic rate. This behavior is the exact opposite of speculation. It is a powerful signal of long-term conviction from holders who have no intention of selling at current prices. Finally, there is the reality of the permanently lost coins. An estimated 3 to 4 million Bitcoin are gone forever, locked in wallets with lost keys or from owners who have passed away. So while we talk about a 21 million supply cap, the real accessible supply is likely closer to 17 or 18 million. Many analysts believe it's even lower. When you combine relentless institutional demand with a fixed new supply of only 450 coins per day, a shrinking exchange inventory, and millions of permanently lost coins, the math points to only one logical outcome: a massive liquidity squeeze. This reveals the fundamental truth of how this market now operates. Bitcoin's price doesn't move when people buy it. The price moves when nobody is willing to sell it. The market corrections you see serve a mechanical purpose. They are designed to shake out the last of the weak hands. Every crash and every dip is a transfer of coins from short-term traders into the cold storage of long-term holders and institutions. It is a process that methodically drains the reservoir of liquid supply, preparing the market for the next phase. Imagine a random Tuesday morning 6 months from now. An ETF goes to fill a routine order for a few thousand Bitcoin. But the sellers who existed during the last crash are gone. The exchange order books are thin. To find those coins, the price has to jump until it reaches a number high enough to convince someone who had no intention of selling to finally part with their Bitcoin. That is what a supply shock looks like. It is not a gentle rally. It is a ferocious repricing event driven by a simple, mechanical lack of willing sellers at lower prices. This is also why events like miner capitulation are paradoxically bullish. As less efficient miners are forced to sell their holdings to cover costs, their inventory is absorbed by stronger hands. The network is then left with only the most efficient operators, who become net hoarders of Bitcoin, further constricting the future supply available to the market. This is the structural imbalance, hiding in plain sight, masked by the noise of daily market fear. Most people watch price. They react to headlines and the algorithm-driven chaos of volatility. But the price is a lagging indicator. The price only tells you what has happened. The real forward-looking signal is in the plumbing of the system, the flow of coins, the incentives of institutions, and the shrinking pool of available supply. The price you see today reflects the market's short-term fear, not the new reality of long-term structural scarcity. The question is no longer if a supply shock will happen. The accounting is clear. The only question is when the market will be forced to reprice Bitcoin based on its true, functional scarcity. The fuse has been lit. We have explained the mechanics of this supply drain. But this relentless squeeze forces a critical new question. As the liquid supply of Bitcoin continues to vanish from the open market, which part of the legacy financial system will be the first to break or be forced to adapt? And more importantly, what will that signal look like?